Okay, right. So we started. I gave a very brief introduction about this relevant costing for decision making last week also. So today we mainly focus on using this relevant costing for decision making purpose, some of the application, right? So one aspect is broadly cost is relevant when it is affected by a future decision, right? So if a cost is not affected by a future decision, it is irrelevant. Similarly, even a revenue, sometimes we have to take a decision based on the profit of both cost and revenue. So revenue also, if it is changed by a decision, future decision, it is relevant. So relevant cost and revenue are those future cost and revenue that will be changed by a decision. The irrelevant cost and revenue are those will not be affected by a decision. So we are going to discuss short-term decision making. So when you are taking some decision, if a particular cost or revenue is not going to change, whether we take a particular decision or not, then that is irrelevant. Right? Cost and revenue which can be influenced by a future decision. That is, those are the cost and revenue relevant to take that decision. Then even last week we highlighted there are some cost irrelevant, some type of cost relevant. First one is the sunk. Sunk cost is irrelevant for decision making. What is sunk? Cost which has already been incurred and cannot be changed by a future decision is a sunk. For a business organization, the material we have already purchased. We have purchased raw material by spending 200 units, 200 rupees per unit. Now we have 10,000 in our stores. Now when you are going to take a future decision regarding this material, the 200 per unit, the cost incurred is irrelevant. So that is already incurred. Right? So whether you are going to use it or sell it or any other purpose, whatever the decision we are going to take, you can't change the 200 rupees that we have already. Right? So that is sum. Then what type of cost is relevant regarding this? We have 200, we have spent 200 rupee material to purchase material, right? We have 10,000 units of material purchased by spending 200 rupee per unit. Now they are in our stores. When you are going to take a future decision, we want to decide. Okay, now this material is not used by the business at the moment because the product that we were manufactured using this particular material, we have discontinued the production. Right? We had several production lines. So one particular product that we use to one particular product produced using this particular material no longer produced. As a result, for last 2 months now this material is there in our stores. Right. Now another industrial customer, right? Another business making an offer, buy this material at 150 per unit. I have to decide, are you going to sell it for 150 or not? Now, when you are taking that decision, when you are going to decide whether we are going to sell this material at 150 rupees per unit, you should not consider the 200 which is already sold. That is some. And that is not going to change by the decision we are going to make. But if there is a current market price for this material still 200. Current market. Then this offer you can reject because you can sell this for 200. But this person is asking only for 150. Oh, say the current market price for this material is 160. In the market, you can sell it for 160. We purchase for 200. Now market price of this material has come down. So we want to decide whether we are selling this for this outside customer for 150 or not. So the relevant cost is, the sunk cost is irrelevant. But if you sell this to 150 for this particular customer, we have to give up the market price that we could have obtained by selling this to some other company. So that is called opportunity cost. The opportunity cost is a relevant cost. When we are going to decide whether we are selling this to this customer at 150 or not, 200 purchase price is irrelevant because that is sum. But if you sell this for 150, we have to give up the 160 which we could have obtained by selling this in the market. So that is opportunity cost. The value of next best alternative for gold. Right? This opportunity cost. So the relevant cost here, 160. So you should not go for this customer say. Instead, your decision should be sell it in the external market. Right? When you are selling this in the external market, you have the relevant revenue of 160 per unit. When you decide to sell it in the external market for 160, the 150, this particular customer's offer becomes the opportunity cost of it. Right? That's relevant. So you compare, you can sell it for 160 in the external market. We have received order for 150. That is a relevant cost, opportunity cost. So still we have 10,000 gain. You should decide, go ahead and sell this. Rather than selling this to the customer that who asked this for 150, it is worthwhile sell that in the market. Right. Then we have another alternative. Another customer come and make an offer. He is willing to buy this material that we have purchased for 200. Current market price 160. Customer A come and make an offer for 150. Customer B come and make an offer, buy this material at 180. But he needs further processing of this material. He needs a kind of modification to material. That will cost us additional 10. What is your decision? Scenario is we have purchased the raw material 10,000 units, 200 per unit 2 months ago. The product that we were using, producing using this particular material is discontinued now. So no longer produce that. So this material is there in the stores for the 2 month period, unused. Cost equal 200. Customer A make an offer to buy it for 150, but current market price for this is 160. So we refuse to give it to customer A. Meanwhile, customer B come and make an offer. He is willing to buy it for 180. But he needs an improvement for this material. We need further processing. That will cost additional 10 rupees. Now, what is your decision? Are you going to sell it in the market, current market for 160? Or further process and sell it for 180? So when you are taking that decision for the process, 180, what are the costs you take into consideration? Now you are willing to sell it for 180, right? 180 would be the relevant revenue. What are the relevant costs here? 160 current market price, that become opportunity cost, right? That should be relevant. In addition to that, there is a 10 rupee further processing cost. 10 rupee further processing cost. Further processing cost is relevant because it's an avoidable cost. If you don't go for the further processing, you could have avoided that 10 rupee. Because of this decision, we have additionally incurred 10 rupee. So the avoidable cost is relevant for decision making. This is mistake, right? Avoidable cost is relevant for decision making. Unavoidable cost irrelevant, right? Avoidable cost is relevant for decision making. Avoidable, it is relevant for decision making, right? This 10 rupees avoidable. They assume that the cost which can be avoided by implementing a decision is known as avoidable cost. Right? Assume that whether you are selling this to in the market or for the customer A for 150 or customer B 180 after further processing, per unit you have to spend 2 rupee transport. Right? We have three alternatives. Sell it in the market for 160, or sell it for the customer A 150, or sell it for customer B 180 after further processing. All three scenarios, you have to transport it to the buyer's place. That will cost you 2 rupees. Right? Transport. So that you have to package it. Right? Packaging cost equal 2 rupees per package. That packaging cost is unavoidable cost for all three alternatives. Right? 2 rupees. So then it is irrelevant. But the point, right? So this is how you should consider the situation when it comes to decision making, right? Just to explain this concept, I use a hypothetical scenario that we have a material purchase for 200 per unit 2 months ago. 200 is a sunk cost, irrelevant for future decision. Now we are not taking any use of this. We have a current market price of this for 160, and customer A made an offer to buy it for 150. Customer B made an offer to buy it for 180 after further processing by incurring 10 rupees. So all three alternatives we have to spend 2 rupee packaging cost, right? Packaging. So what is the best option that we should take? The best option is we should accept the order of customer B, further process this and sell it for 180. There the relevant cost, relevant revenue is 180. 180 you can earn. The relevant cost is 160 opportunity cost of the current market price. We could have sell it in the current market for 160. Plus further processing cost, the avoidable cost. If you don't accept this customer B offer, you could have avoided that 10 rupee. That avoidable cost also become relevant. Although the total relevant cost of implementing the decision to sell this for customer B is 170, 160 market price, the opportunity cost, plus further processing cost, the avoidable cost 10. Altogether 170. But still, you have 10 rupee gain by implementing this decision or the other decision. So we could go ahead with the customer B. Right? Committed cost. Committed cost means cost which is already committed and cannot be changed by a future decision. This difference with the sunk cost is already incurred. This cost has not been incurred but committed. Right? Committed. We have already agreed to incur that cost. So which cannot be changed by future decision. Like we have came into an agreement get an insurance of this material. Right? Insurance cost per unit is 1 rupee. Right? When you say that coming to an agreement means that is already incurred on always we take is committed like this way. Yes. Basically, okay, even insurance, right? It is coming to the agreement, right? To be spent here, right? So we have committed. Right? That you have to anyway incur. Or this material you need to you have already decided have a store, right? Now this material in outside place, right? We have already came with an agreement to construct a store, right? To store this material. So it is there in this. That constructing the small space of store will cost additional 3 rupee, right? Per unit it will cost 3 rupee. The total cost you divide by number of units, it cost us 3 rupee. That agreement has already made. Contract has signed. Whether we keep it, whether we sell it to customer A or customer B, you cannot reverse the this agreement. Right? That means when you are considering the decision, this cost should not be considered because it is already committed. Right? Now you can't say no, we are going to sell this, so we need not to have this store. Right? You can use it for some other purpose, but anyway, this cost is committed. You can't change. Right? You cannot spend it. You're going to spend. Right? It's a committed cost. Which a cost already committed. Then it is not only the cash flows relevant. for the decision makers. Non-cash flow also relevant for decision. Non-cash flow. Example. And you take even opportunity because sometimes there is no cash flow involved. Right? You could have used it for some other thing. Right? There is a cost saving or something. Right? The cost saving you could have achieved. So that there is no direct cash flow involved. But it's relevant. Right? So the relevant cost should not necessarily be cash. Right? Now, because sometimes we are not incurring, right? No cash flow there. But it is relevant. Right. Have a simple activity here. Let me go through.
Thank you. Anyone?
Sigma PLC has purchased 500 rupees, 500 rupees worth raw material few years ago. Currently, there is no possibility of selling these material or using them for future production. Recently, a customer saw this material at the company and premises and request the company to sell those material to him. However, this customer is not prepared to pay more than 280,000. The additional cost of 90,000 would be required to change this material according to customer requirement. Now, if someone consider the 500,000 already spent and then gets the offer for 280 and reject it, no, I have already spent 500,000. That is not the way that we should look at it. Right? So that 500,000 already incurred, you cannot reverse it. So that is a sunk cost, irrelevant for decision making. So if you don't go for this, you can't recover the 500,000. That's gone. So that's totally irrelevant sunk cost. The only relevant cost is the further processing cost of 90,000. You have to incur to modify this material according to customer requirement. So that's a relevant cost 90. And when you are spending 90, you would have earned 280. There's an incremental profit by accepting the offer. 280 minus 90, 170,000. So the relevant cost is 90,000 further processing cost. Relevant revenue is the 280,000 the amount customer will pay. So there is an incremental profit of 170,000, 190,000. Incremental cost of 190,000. So the company should set this money. Right? That should be the decision. Okay. Now activity 2. right? Company has received special order from a customer to produce 1,500 units for a customized product. The special order requires additional variable cost rupees 40,000. To produce 1 unit of this product, 2 machine hours are required. Currently, machines are working at their full capacity. If special order is accepted, current output of product A, the standard product, will have to be reduced. Produce 1 unit of product A, 1.5 machine hours are required. Contribution per product A is 30 rupees. Find out the opportunity cost of fulfilling customer order. We have received customer order to produce 1,500 units of the customer product. And the additional variable cost 40,000. But if you are going to accept this order, there is an opportunity cost. We have to use machines. The currently machines are working full capacity. Special order accepted. Current product will have reduced. To produce 1 unit of product A, 1.5 machine hours are required. So that means in order to produce this special unit of 1,500, we have to sacrifice to produce 1 unit of this product, 2 machine hours are required. So to produce 40,000 units, how many machine hours required? Number of machine hours required if accept the special order. We accept the special order to produce 1,500 units. It requires 2 machine hours. So if we accept this order, special order, 1,500 into 2, 3,000 machine hours required. Since the machines are using full capacity, number of products number of units of product A would have been produced. You see, 3,000 machine hours. You can find it 3,000 machine hours to produce 1 unit of product A, standard product. It cost us 1.5 machine hours. So we could have produced 2,000 units of product A using this 3,000 machine hours. So the country opportunity cost accepting the special order, which is the loss of contribution from A. So we could have produced 1,000 units of product A. And you were given product A contribution is 30. So which is 60,000 rupees. The answer for part A, the opportunity cost, 60,000 rupees. Opportunity cost of accepting a special loan. Okay. Right. Then we have the second part. What is the minimum price we should charge? The minimum price should cover the full cost. So opportunity cost 60,000. Then the additional variable cost of special order will cost additional variable cost 40,000 rupees. 40,000. Then the minimum price we charge for special order 300,000 to be able to cover the full cost. No? A answer 60,000. The minimum price to be charged should cover the full cost. Please, the full cost, the break even, right? Then you given 7 types of cost item, 7 types of scenarios, and you are asked to indicate whether each cost is sunk cost, incremental cost, variable cost, fixed cost, semi variable cost, semi fixed cost, controllable cost, non-controllable cost, opportunity cost. Right. Now, first we will look at these terms. The main terms of right? Management account. Right. Some cost we have discussed already. Cost incurred and cannot be changed by a future decision. Incremental cost. The incremental cost is additional cost to be incurred by implementing a decision. Right? Incremental cost, additional cost. The increment. Right? When you are implementing a particular decision, if you have additional incur that cost, incremental cost. Variable cost. Cost that vary proportionately to the number of units produced. I hope you are aware of that, right? Variable cost vary when the number of units produced vary. Fixed cost which remains constant given range of output, right? Fixed cost. Semi-variable cost. Semi-variable. Semi-variable cost has a fixed component as well as variable component, right? Now, if you consider before came into this unlimited packages for mobile phone, right? Normally we had most of the packages, it is semi-variable. It has a monthly fixed rate bill, right? Using that, you can take say dialogue to dialogue, mobitel to mobitel, 1,000 minutes free or unlimited free. For other network, it will vary. Number of minutes, it will vary. So it is semi-variable. In production factory, sometimes employees are having a monthly salary, minimum monthly salary, plus per unit, there is a variable rate, right? Some employees are paid 20,000 monthly salary, and they have to standard minimum production. Okay, you are paid 50,000 monthly salary, standard salary. You have to produce per month, say 5 units, 10 units per day, say into 20 days, 200 stand. But if you exceed the 200 units. So each additional unit, you are entitled for 500 rupees or something. So then if the employee produces 250 units, his salary should be 50,000 plus additional 50 units into 500, 12,500, 62,500. When you take that employee cost from the business perspective, it's a semi-variable. Semi-variable cost means it has a component of fixed plus variable. Now, if you take electricity bill, nowadays electricity bill is semi-variable, right? We have a fixed range, right? Something like 1,000, 1,500 fixed, right? That also vary according to the number of units consumed, right? But there's a fixed portion. Then in additional unit, will vary. So semi-variable, right? Semi-variable means it has both fixed component and variable component. Then what is semi-fixed? Semi-fixed. Over the fixed cost becomes semi-fixed in the long run. Fixed cost doesn't become variable, but after particular capacity level, it becomes semi-fixed. Like this. You have a factory. Within that factory, you can employ 100 workers and you can produce 10,000 units per month. Like a rented factory, your monthly rent is 200,000 rupees. If you want to expand your production beyond 10,000, right? You are planning to produce 15,000 units. You have to rent out another factory building. That will cost you another 200,000. If you are planning to produce 25,000 units, you have to rent out another factory building. That will cost you another 200,000. So for a range of 10,000 unit production, for 100 employee work, factory rent is 200,000 fixed. But after 10,000, it will suddenly increase up to 400,000. Right? Remain cost. So it's go like steps. We call it semi-fixed. With the semi-fixed cost, there is no variable component. It is fixed. After certain level, it will increase. Now, if you take supervisor's salary of a business, if you have employed 5 supervisors, right? One supervisor pay 100,000 per month, supervisor salary is 500,000. But if you recruit more employees, more workers, enhance the production, you have to recruit another employee, another supervisor, that will increase cost to 600. Right? For a range of employees, you can use one supervisor can supervise 10 employees. At the moment, you have 50 employees and 5 supervisors. So if you recruit 60 employees, you need 6 supervisors. 70 employees, 7 supervisors. So this supervisor salary increase not in a variable, not per unit. After particular level, it will go up. Then again, you further expand up to certain level, again it will fix. Right? Using 50 employees, you can produce 5,000 units per month. If you are going to produce 500,000, 500 units, you need 6. If you are going to produce 7,000 units, you need 7 supervisors. But 5,000 to 6,000 range, you can manage with 6 supervisors. So it's not varying. It is semi-fixed. Step cost. Right? Okay. The semi-fixed cost curve like this. normally take this way. This is the variable cost. Total variable cost varying with the number of unit increases. So this is quantity. This cost. This is the behavior of the total variable. Fixed cost is like this. Whatever the unit of output, it remains constant. Semi-variable cost something like electricity bill. Like this. Semi-variable. It has a fixed component. Increase there. There are different modes. Even this can be semi-variable, so many other alternatives also. It can somewhere come to this fixed, thereafter variable, right? Whatever it is, has a fixed component, right? Then semi-fixed cost. Like this. Right? Behave like this. This semi-fixed. Step like. Right? So even though we consider fixed and variable in the very short run, that is okay, right? But in the long run, most of the fixed cost converted to semi-fixed cost. And practically, some of the variable cost actually there's a fixed component also. Those are semi-variable, like electricity bill nowadays, Sri Lankan context. Telephone, I think, is still the landline having the same fixed scenario. Right? We have a package, no, up to particular limit, right? Get a call thereafter. Some employees' salary, special production employees, they have a monthly fixed cost, fixed salary plus vary with the output. then the building rent and supervisor salary, those type of costs are semi-fixed, right? Up to particular age fixed. Thereafter, if you want to expand, it will be suddenly increased, and thereafter again fixed for a particular level. Right. So sunk cost, incremental cost, variable, fixed, semi-variable, semi-fixed. Controllable cost we have already discussed in the performance evaluation perspective. If the cost can be controlled by a particular divisional head, that is controllable to that particular division, particular level of management. Right? We discussed in the supermarket, if the manager can decide number of employees work in the supermarket, the employee salary is a controllable cost. Right? How to make some advertising or electricity lighting, right? Those things, use of them, cleaning, staff, maintenance cost, if it is controllable by the manager, that is controllable. But the building rents is decided by the head office, and the factory manager can't do anything, right? You have to run the sales outlet within the given location. So that factory rent is an uncontrollable cost to the manager. So when you are considering performance evaluation, that should not be considered. That is uncontrollable. So controllable means any cost that can be controlled by a particular management level. So that control can, that any cost which cannot be controlled, non-controllable. The opportunity cost we have already discussed. Cost of next best alternative given. Right. Now we can take the first one. A company is considering to selling an old machine. Machine has a book value of 200,000. In evaluating the decision to sell the machine, rupees 200,000 is a sum cost. As an alternative to old machine, company can rent a new one. It will cost 30,000 a year. In analyzing CVP behavior, the rental is CVP, cost volume profit analysis. It's the cost. Right. Added to the okay, third one. To run the firm's machine, there are two alternative courses of action. One is to pay the operator a base salary plus small amount per unit produced. This makes the total cost of operator semi-variable, right? Semi-variable means the variable fixed semi-variable, right? It is semi-variable. Can you attend the next 4, 5, 6, 7, right? Providing material, same question. So as an alternative, the firm can pay operators a flat salary. It would then use one machine when volume is low, two when it expands, three during the peak period. This means total operator cost is now to be operator flat salary. Then it can use one machine when volume is low. And volume is high, two machine. Peak period, three machine. Right? So that becomes semi-fixed. Semi-fixed. The machine mentioned in one would be sold for 80,000. Mentioned in one, the old machine with the current book value of 200,000, which could have sold for 80,000. If firm considering retaining and using it, 80,000 is an opportunity cost. If firm wishes to use machine any longer, it must be repaired. For the decision to retain the machine, the repair cost is again. When you decide to use the machine, it's a relevant cost. No? That is an incremental cost, additional cost to be incurred by implementing a decision, incremental. The machine is charged to foreman for each department at a rate of 30,000 a year. Evaluating foreman, the charge is, when you calculate the foreman, the machine operator, each machine, the foreman is charged 30,000 for the machine. This is the machine cost to divide among the foremen and charge 30,000. When evaluating the foreman, it's 30,000. This is uncontrollable cost to the foreman, right? It is like cost allocated for each foreman. So when you are evaluating the performance, this is the cost of machine divided by the foreman. So that cannot be controlled by the foreman. And that is machine purchase top management decision. They don't have a control over the cost of the machine. So this is non-controllable cost. Character from Dury 2000 Dury. Heard about the famous management accounting by textbook writer. Right. Okay. this one. You consider this your CDP knowledge little bit. Company is producing 4 products and planning its production mix for the next period. The estimated cost of sales and production data are given. For product W, X, Y, Z. Selling price per unit 20, 30, 40, 20. Labor cost 4, 6, 4, 40, 10. 2 rupee per hour. Material 1 per kilogram. 6, 18, 10, 12. Maximum demand 5,000, 5,000, 5,000, 5,000. This is also actually adapted from the rupee. So that is why you find 2 rupee per hour. This is dollar, right? Or pound, right? So forget about the value, right? We'll just go ahead with the calculation. Based on given data, what is the most appropriate product, appropriate mix if labor hours are limited to 50,000 hours per week? Now, when the company is producing several products, how do you decide the priority, which product to be produced? The short run. Which cost we consider as relevant in the short run? Last week we said the short run decision making. Variable cost is the relevant cost. Right, so you were given the variable cost information, labor per unit, material cost is given. So from the variable, from the selling price, when you deduct the variable cost, the difference is known as what? Selling price minus variable cost, contribution, right? Contribution. So you all learn about CPP, right? So, right. So we take activity here. We know the maximum demand is 5,000. So we can have the contribution per unit. Labor, this is a variable cost. Material, also variable cost. From the selling price, you can deduct the variable cost. So you will get the contribution. Contribution per unit. So if you are given, right, no restriction of labor or material, then the priority should be given to produce product Y, because product Y 1 unit gives you higher contribution, 60. Right? So if no restriction of output, no limiting factors given, right? Any factor limit your output is given, then you can take contribution per unit. I is the highest. So we should first the prioritize by rank 1, I said 2, and XNW 3. Audible. But here the question says, what based on the given data, what is the most appropriate product mix? The labor hours are limited to 50,000 hours. So the limiting factor is the labor hours. Labor hours. So you can have number of labor hours required per unit. Right? Number of labor hours required per unit. How to find that? We have a 3 rupee cost labor hour. Our rate is 2 per labor hour. That means 6 rupee means number of labor hours 3. 6 divided by 2. The labor cost is 4 rupee. So that means 4 divided by 2, 2 hours. And 14 labor hours means it requires 7 hours. 10 labor hours means it requires 5 hours. So accordingly, number of labor hours required to produce 1 unit of W, X, Y, and Z. 3 hours, 2 hours, 7 hours, 5 hours. We get this labor cost per unit divided by 2. Then we can find contribution per labor hour. Labor hour එකට contribution එක බලන්න. How to find it? You can divide this contribution by the labor hours. Contribution per labor hour. Now, since we have a restriction of number of labor hours, we should rank what is best to produce by the company based on contribution per labor. Rank කරන්න ඕනේ. Contribution per labor. So highest contribution per labor hour used by product X. Then Z. Then W. And finally, so we should prioritize the production based on contribution per labor hour, because the total number of labor hours available for the business is 50,000 labor hours. So now we should not rank it based on contribution. Now, if you look at the contribution, the highest contribution per unit is Y. But based on the contribution per labor hour, it is the lowest. Because even though it gives 16 rupee contribution, it requires 7 labor hours. So labor hours is the limited factor here. The limiting factor labor hours. So you have to select the production based on highest contribution per limiting factor. Here the limiting factor is labor. Now we rank it. Then we go ahead with the best production mix. Right. Now can you find how we should produce the product? Now each product demand is 5,000. So then first we produce product X. So we can find the profit maximizing product mix. The product mix. So you can select OK. First you select X. 5,000 units of X. Right? X only 5,000 other one. Right. When you produce 5,000 units, what the labor hours are clear? 5,000 into. To produce 1 unit of product X, we need 2 labor. Right. 10,000 labor hours here. We have 50,000. So maximum demand for product X is 5,000. X only 5,000. Then you go for the second one. Set. Right. Set වලින් 5000ක් හදනවා කියලා කියනවා. Set 5,000. Set के 5,000 හදන්න අපිට යනවා labor hours කොච්චර? Set 1 unit it require 5 hours. So it requires 35,000. 35,000. Now altogether, out of the 50,000 we have utilized 35,000 hours. Right. Number 3 W. ಇದು W වලින් 5000 හදනවා කියලා අපි බලමු ඉස්සෙල්ලා 5000 හදන්න පුළුවන්ද? W වලින් 5000 හදන්න එකකට යනවා පැය 3ක්. Okay, now we have utilized the full 50,000 labor hours. So we will not go for Y 0. Y හදන එක පාඩුයි. labor hour 50,000 ඉවර වෙනවා. XY XW and Z. So what should be the total contribution? A product mix එකේ total contribution. profit maximizing product mix. Right? Total contribution and profit maximizing product mix. PKK contribution equivalent. High unit එක දැන් හැබැයි unit contribution එකේ වැඩි කරන්න ඕන. Unit contribution එක 8යි. $40,000. State වල 5,000 multiplied by unit contribution 14. 5. Yeah. 5,000 multiplied by 8. Total contribution. So in this particular business, this is the maximum contribution they can earn per month based on the given scenario where the labor hour is the limiting factor. Labor hour limited to 50,000 labor hours. The total contribution, the maximum total contribution is 150,000. While making a product mix එකක් දාලා බැලුවොත් මේ පැය ගන්න කවර් වෙන්න. ඒ කියන්නේ පැය 50,000 කවර් වෙන්න. 150 වලට වඩා අඩුයි තමයි. right? Less than 1. Right. දැන් මේ විදිහට මේ පාර්ට් එක දැන් ඔයාලා profit maximizing product mix එක අපි බැලුවා. Right? Based on the limiting factor labor hours. We have the second scenario. What is the most appropriate mix? Material are limited to 110,000 kilograms. The limiting factor is material. So the material kilo එකක් රුපියලයි. එහෙනම් contribution එක මේ ගානේ දෙනකොහම අපිට බලන්න පුළුවන් what is the contribution per kg. Based on that now you have to rank. Right? දැන් labor hours වලට හැදුවා. ඒ වගේම මේ format එකක් හදන්න පුළුවන්. Material based culture and limited to 110,000. Can you attend? Part 2. Yes, I will use the same format we had earlier. Now first, now it should be the number of material kg required per unit, right? So which is 6 divided by 1. So it is say 6, 80, 10, and 12. So contribution per, and take raw material RM, raw material kilogram. Right? Number of raw material kilogram required. Now we have to rank it. Now the highest goes for Y. W, Z, and N. Now if the material is the limiting factor, Y becomes the most profitable. I become the most profitable. Then W. Then he said that X become lowest. Again, අපි මුලින්ම හදන්න ඕනේ Y. Then have Y 5000. Y වලින් හදන්න එකකට යනවා කිලෝ 10ක්. One 5,000 into 10. එතන යනවා 50,000 kilograms. Total we have 110 now, right? 1,000 kg. දෙවෙනියට අපිට යන්න පුළුවන් number 2 W. W වල 5000ක් ගියොත් unit 5000යි. W we need 6 kilograms per unit. Six into 5,000, 30,000. 30,000 kilograms. ඔක්කොම 80යි. Third is it. Set 5000ක් කියොත් set එකක් හදන්න යනවා 12. 12 into 5,000 cost us 60,000. අපිට අපිට තියෙන්නේ කීයද? අපිට තියෙන්නේ 80 ගියාම තව 30,000 තමයි තියෙන්නේ. right? එහෙනම් අපිට ඉතිරි වෙලා තියෙන්නේ 30,000. 110 total kilogram. So here we have 30,000. එක යුනිට් එකක් හදන්න ඉසෙට් වල යනවා. good. එහෙනම් 30,000 වලට හදන්න පුළුවන් 2,500. It should be 2,500. Not 5,000. Then hadakat pula the just pass. So 3 products, 2 5,000 each. And X no production is the mix. The main mix again. After the one contribution, Y will contribution 16. 5,000 into 60. 8,000. W contribution 8. 5,000 into 8, 40,000. He said only 2,500. 2,500, he said contribution per unit 14. Total contribution here 155,000. This is when the limiting factor change. Limiting factor 110,000 kilogram of raw material. Scenario තමයි මෙන්න. Hundred 10,000 kilograms of protein. The short break can continue the remaining part after the break. Right. So shall we continue? So we work out up to activity 4, right? So here that these concepts, right? The sunk cost, incremental cost, controllable cost, opportunity cost, variable cost, fixed cost, semi-variable, semi-fixed. The concept is important is short-term decision making. That is what we discussed. Right. Is regarding your individual assignment. So the topic allocation is already there, right? And the deadline is today is the week number 5, right? 6 and 7, 2 more weeks, right? I have uploaded some material for your reference because basically if you take the topics allocated, individual report, so you have pricing strategy, application of pricing strategy. So this week 4, I have uploaded this pricing techniques material, so you can have some kind of guidance for these pricing strategies. And balance scorecard, we have balance scorecard material also uploaded. And the other group, environmental management accounting, EMB, right? So here we have another material. Environmental management accounting material also uploaded. Right? That is for your reference, right? You should not think that what is there in that material, right? That is the kind of reference. So you can search so many materials from the internet and do your study appropriately. And both group basically the activity-based costing, right? So I did not upload separate material because we have already discussed that activity-based costing of a selected material, right? So you can use some guidance from there. But all these topic, it is application, right? The application of pricing strategy, application of balance scorecard, application of environmental management accounting, application of ABC. You can include some theoretical part, right? But mainly can include some theoretical part, some kind of explanation, but you have to give some introduction of your organization also, stated organization, right? Yeah. Take a bit on introduction of the company. So theoretical explanation of pricing strategy or balance scorecard or environmental management accounting or activity-based costing, whatever your selected topic, and application of any of these, and finally you can have a summary. Right? So it is my content again. Right? Then pages of the report. Page. General reporting guidelines applicable. Right? So general reporting guidelines දැන්ටම දාන්නවා. සාමාන්‍ය assignment වලදී ඔයගලන්ට හම් වෙන guidelines. එක වෙනසක් නැහැ. ඒ කියන්නේ Times New Roman 1.5 right? මේ guideline clear here. Well, font size. Deadline. Date, week number, ionic. Right? The 1 A, B, C, 2, last week, yeah, 5, 6 and 7, right? 2 weeks in, right? Number 7, with a group presentation, if it's not applied, right? Entry group presentation. Right? The 7th week, we have 2 more weeks, go ahead with the so it could be eight 15th October. Yes, funding calamity and big delegation. So you create a link. So you have to upload the Word document, the given thing. So the report, you can have any amount of appendix because it's not a printed version, right? Appendix දාන්න පුළුවන් නම් අවශ්‍ය නම් දාන්න පුළුවන් report එකට. No issue, right? And it's just but content should be 10 to 15 pages. we will have a presentation on 10 weekends about maybe ඉවර වෙන්න කලින් කොහොමද අපිට සතිය වගේ presentation එක ගැනත් අපි පොඩක් කලින් දැනුවත් කරලා තියන්න, right? So we have time for the group presentation. I will go ahead with the same groups, right? So you will think of financial report. Then we got a group list එක තියෙන එක right? It's an individual, right? So obtained 1, 2, 3, 4, 5, 6, 7, 8 groups here, right? We allocated 8 topics. කාටද වෙනසක් කරන්න අවශ්‍යද? And we go. So I hope that all these students are here, right? No additional students and group P1 එකේ පස්සේ original list එකේ ඉඳන් මම එයාගේ නම මෙතන දාලා දෙනවා. But anyway, the both groups have the same topic, right? So no issue. But in the group assignment, I will allocate it to the PT1, right? So no issue. Right. So then we will continue the discussion. The acceptance of the special order. So we have already discussed about this. Special order is different from the normal condition. So when we receive the special order, there will be a variable cost. So when you are setting a price, you should be able to recover the variable cost of accepting the special order. So variable cost is necessarily relevant cost. Under normal circumstances, fixed cost will not be relevant because special order comes for the continuing business. So whether that order received or not, your normal process, business process will be there. So yeah, there will not be change in that fixed cost. Under normal circumstances, for the special order, there won't be increase of the fixed cost. Right? Then you compare the variable cost. But in that case, you have to take into consideration the opportunity cost. Right? There may be loss of contribution of existing product. We had earlier some activity awards, right? So if that loss of contribution is there, that should take into consideration. Right? Here we have an activity. So X Limited manufactures and market drink that they sell for 20 rupees per bottle. The currently output is 400,000 bottles per month, which represent 80% of the capacity. They have opportunity to utilize their surplus capacity by selling the drink at 30 per bottle to a supermarket, which will sell its own label product. The total cost of the last month, 560,000, out of which 1.6 million fixed. Based on above data, write a report to board of directors whether to accept this special order and other factors that has to be considered in making the decision. First, you look at the financial perspective. Right. So the fixed cost is 160,000. Yeah. Fixed cost per month. $160,000. So the total variable cost right, so it is given for a month. So total variable cost total cost 560, of which 160 fixed. So 400. Right? Sorry, 4.6 million, 1.6. 1.6 million and 4 million. Right. What is the number of units? The 80% of the full capacity is used. The full capacity 400,000 bottle, 80% produced. 400,000 into 80%, 320,000 bottle produced. That means variable cost per unit.
The current output is 400. Current output is 400.
Current output 400, eh? Okay. 400, right? The 80% is 400, right? That means variable cost per unit is 10. Now offer price offered 30. That means there's a contribution from special offer. Review. So when you consider the because fixed cost is not going to change whether we accept or not, right? So the maximum contribution, maximum additional contribution, how much? Current output is 400,000 with the supermarket. They have opportunity to utilize the surplus capacity and sell it for 30,000 for a supermarket, which will sell at their own label. The total cost 560 of which 1.6 fixed. Right. About 400,000 equal to 0.8, 80%. අපිට තව ඉතිරි වෙලා තියෙනවා 80 100,000 units තියෙනවා. Into 3, additional contribution would be 300,000, right? 400,000 percent capacity. ඔය 80ක් 80 20ක් කියන අපිට හදාන්න පුළුවන් unit එතකොට 100,000 contribution 3 300,000 capacity of that productive special order. So financially, one can argue that better to accept this, right? Because in the short run, it will give you additional 300,000 because we are utilizing the unused capacity. So there is no direct opportunity cost from the production side. Production side, because we are using the unused capacity, so we are not allocating any of the resources allocated for existing production. So 3 rupee contribution for 100,000 units we can produce. The maximum additional contribution we can obtain by implementing this decision is 300,000. You can note down like in the report, right? We have mentioned this. But interestingly, now we have mentioned the other factors that has to be considered making the decision. Now, when you are taking this decision, whether to go ahead with this order or not, it should not be purely based on financial terms. Even financial, not only based on this contribution. What are the other factors that should be considered, which is missing those information here? Yes. Given scenario, the other factors that would affect for this.
₹20 demand will reduce. ₹20 demand will reduce.
Here, now we are selling this product at 20 rupee, right? Present contribution contribution from existing sales. Existing sale value contribution එක තියෙනවා. Variable cost 10, sell for 20, 10 rupee into 400,000 units. Right? They have 4 million contribution. Right? Now, when you sell this for a supermarket, and if the supermarket purchase it for 13, they can sell it at a reduced price. Right? They can keep 5 rupees and sell it for 80. As a result, there may be drop of our sale. Dropping 1 unit of existing sale will reduce 10 rupee contribution. Right? So, financially, to recover this maximum contribution that we can take 300,000 by taking this special order, right? If for the maximum drop off existing for the present maximum drop off existing product without a loss. අපිට total loss එකක් නැතුව maximum loss වෙන්න පුළුවන්. Number of unit කීයද? We are having 300,000 additional profit. Right? මේකෙන් 10 ගානේ හම්බ වෙනවා. The loss of one unit will drop 10 rupees. So if our existing sales 400,000 30,000 drop වුණොත් මේ contribution එක අලුතෙන් එන contribution එක totally erase වෙලා යනවා. Right? කියන්නේ as a percentage එකක් ගත්තොත් from 400,000 it is 8% approximately. Right? අපේ sales 8කින් අඩු වුණොත් existing sales අපිට 8කට වඩා අඩු වුණොත් අපිට financially loss වෙනවා. Is that clear? Right? When you accept this offer, our product will be sold by other supermarkets. As a result, that information is not available. The මේක නැහැ. Right? මෙතර අපිට දැන් තියෙන්නේ. This is not available information. This information not available for us. But in the decision making, we have to consider these factors. How many units of sales? So if our sales drop by 5%, right? That means by 20,000 units, there's a 200,000 loss. So the net contribution become 300,000 minus 200,000, only 100,000 loss. So we can't take the decision ignoring that fact. There can be a direct decrease in the demand of existing product, existing sales. Right? So there will be a loss of contribution, even though from the manufacturing side, there is no factory impact එකක් නැහැ. හැබැයි මෙතන තියෙන. Right? හරි. The buckets. What are other factors? That is the direct financial impact. Right? So if our sales drop is less than 8%, still financial this may be worthwhile. Right? අපි මම කිව්වා වගේ 5 නම් අඩු වෙන්නේ. අපි estimate කරලා 5ක් අඩු වෙනවා, right? එතකොට loss of contribution is from the 2,000 the 20,000 unit into 10, 200,000 loss. The additional contribution 300,000. Still we have 100,000 gain. But again the problem is our same products now will be sold at a different label. Right? So that will lose the brand image of the business, because now there will be another brand having the same taste. Right? So customers who are loyal to our brand, we may lose our loyal customers even because the same product now available at a low price. So in this type of scenario, what the buyer will do, the supermarket, what they can do, they can sell this at a very less price. Sometimes even the less than their purchase. If they are producing, selling it for 13, they can even sell it for 10 rupees. Then it is at a 50% of the cost. Right? People who try will get the same taste. So then our product demand drastically reduce. Right? That will adversely affect our brand demand in the long run. Right? So there can be long run consequences to the business. Right? We may lose the existing loyal customers. So always a brand having a customer base that create by positioning the product. Right? So it is very important for the business how you position your product in the customer's mind. If you correctly position the product, that's it. Right? So organization try to keep that the positioning, right? Because once you position a product in the customer's mind, that's it. That's create a long run success. Right? And that this decision might affect adversely to that. Because the same product, your product, and they are using a different label. So they can easily capture the loyal customers of your business as well. Right? When they taste, it's the same product, same taste. So that might have a significant drop in your sales, even go beyond this contribution decrease. Maximum drop of the loss here we take 30,000. Right? That is for the you take one of our product, someone dropping, he's going to buy the other product. But sometimes what happens when the same product at a much cheaper price, your loyal customers, their loyalty reduces. So they will try even other products. As a result, even though you are not selling it to supermarket, your product, right, your sales might drop by not 8%, even 15%, 20%. That will be fulfilled by some other competitors. Right? That can happen. So strategically, this is not a good decision to be made, which can create some short-run profit. So this can be accepted in a situation company is having a serious financial crisis, cash flow crisis, right? So you cannot survive. So in such a situation, yes, by even with the considering the long-run adverse impact, you take some actions. Right? And you need to, once you recover it, immediately have to reverse it. Keep stop. The similar thing what the central bank did last year. They increased the interest rate, right, by 13%, 1,300 points. What happened as a result? People, so when the central bank increased the rate, the FD rate increases. People were used to use the money and buy the product. Like suddenly the FD rate around 25%, right? By doing the business, you can't take that normally. 25% return nowadays very difficult, right? From a legal business to a. So people started to use money in the FDs. So as a result, money circulation in the country increases. So inflation control, right? Inflation control. The level of increase in the price level control. Still prices are increasing, but it has control. It didn't go for high inflation. But you can't continue it in the long run because any business cannot buy. Now when the FD pay 25%, bank offer loan interest something like 30%. So you can't borrow 130% and run the business and earn a profit. Right? That had a huge adverse impact on the business world. The central bank knew that, but they took that as a control strategy. Then, after some time, when they started recovering, so they decrease the interest rates, and now the FD rates are very low again. Right? Now people are not putting their money in FDs. Right? That decision was taken, so that is not a usually increasing interest rate that high is not good for economy, right? Under normal circumstances. But there was a special scenario that they had to do it for a short period reverse. So if this particular company facing some kind of severe liquidity problem, they don't have cash flows even to settle their pay their salaries, the salaries of the employees, right? Meet day-to-day operational expenses. Such a situation, for a short period, they can accept this. But before making too much damage to their brand, they should stop. Then that product is not available in the market. And then they can still keep their customers. So there are financial factors and the factors you have to consider. Then another very important decision, dropping a loss-making product. Especially when a business produces several products and one product is loss-making, you can take a decision to drop the loss-making product. But when you are deciding which product we drop, you should not consider the financial reports or the normal management accounting full cost approach calculated loss. Because when you take the full cost approach, right, what you identified as a loss-making product may not be incrementally creating loss. That loss might created because of arbitrary allocation of the overhead cost. Normally, overhead cost of the business you are allocating among all the products, right? So there you have to consider the contribution, right? Fixed and variable, and any avoidable fixed cost if you drop this product. Now, sometimes if you drop a product, there may be certain fixed cost you can say. For example, we are producing this product using a rented factory building. If you drop that product, part of the business fixed cost, now we are paying monthly 100,000 rupees for this particular factory building. If you drop this product, this factory no longer be required, right? You need not to renew the lease of that building. So you can save 100,000. That is the avoidable fixed cost by dropping the product. So that should take into consideration when you are deciding whether that product should be dropped or not, right? You have to consider the variable cost and the contribution. Under normal circumstances, if a product giving a positive contribution, you should continue the product. However, if there is avoidable fixed cost, that also should take into consideration. So here we have an activity. So X company has a range of products of which revenue and cost data are as follows. X, Y, Z, sales, total cost. Total cost comprises 1/3 of fixed cost. Marketing manager of the company argues that product X is making losses. Hence, it should be discontinued. The managing director of the organization seeks your advice for the issue. First, we can take this information. First thing, you have to break this cost into two categories. 1/3 is fixed. That means 2/3 is variable. Right? So we can have a schedule. Like this. The product. The products are X, Y, Z. The selling price we have the total sales revenue. Now sales revenue 32,000, 50,000, and 45,000. Then the variable cost. Two-thirds of total cost. Right? So you were given the total cost 36,000. Then by total cost 38,000. It said total cost is 34,000. Now we can have the total contribution. Then we have fixed cost. The 1/3 of the total cost fixed. So that is the 36,000, 1/3. 38,000, 1/3. And 34,000, 1/3. Then we have topic follows. Now the managing director suggestion is, marketing manager suggestion is, since X ended up with a loss of 4,000. you should discontinue the product, drop the product. So what is your decision? There are so many factors, right? Now, based on what argument you can say that X should not be dropped? Yes. If you take this entire fixed cost is unavoidable, the fixed cost incurred to the business as a whole. So even though you drop the product X, the total fixed cost, the company, right? So even though you drop the product, is this the total fixed cost 36,000 is unavoidable? If that is the scenario, then the decision of dropping the product should be made purely based on the contribution, right? If the entire 36,000 fixed cost of the company is commonly incurred for all three products and unavoidable even by dropping the product X, then the decision should be made purely based on the contribution, totally ignoring the total cost. If that is the case, then the decision should be taken that X should not be dropped. Why? It has a positive contribution of 8,000. Clear? ඒ පළවෙනි සිතාන්ත. right? අපි මේක තව පොඩ්ඩක් if the total fixed cost is incurred commonly and unavoidable by dropping any product, in that scenario, decision should be made based on only the contribution. So all three products generate positive contribution. So product X generate positive contribution. So if you drop the product, you are losing 8,000 contribution. 8,000. But if you are given entire fixed cost is avoidable, that means you have separate factory, separate fixed salary employees. So if you are closed down, you can shut down the business, that particular division, right? So there is no allocated fixed cost to the product base. All the fixed costs are avoidable if you drop the product. It is also possible. You have a separate factory, separate staff, right? So all these fixed costs that we have considered are directly attributable to the not for the unit, right? But for that particular division product. If that is the case, the total fixed cost is unavoidable. The total fixed cost is avoidable. Then, by dropping product X, you can save this loss, right? You can save the full cost. So if that is the scenario, based on financial perspective, you can say, yes, go ahead and drop the product X because you can save 4,000 loss. Can be out. If you are given out of these fixed costs, 50% is avoidable. Out of the fixed cost, 50% is avoidable, 50% allocated cost from the figure commonly. Now, if that is the case, from financial term, what is the decision? Now you have a positive contribution 8,000. And if you drop, you are saving the cost of fixed cost 50% is 6,000. So cost saving that you are giving up is 6,000 by continuing the product. Fixed cost you can save 6,000. But if you continue the product, you can have this additional contribution of 8,000. Still, continuing will give you additional 2,000. Okay? So when the 50% of the fixed cost of product X is unavoidable, that is 50% avoidable. So in that case, still dropping is making a loss of 2,000. Why you can earn 6,000 contribution. When you drop, you are losing that. You can earn 8,000 contribution. You drop the product, you are losing 8,000. But on the other hand, you can save a fixed cost of 6,000. Cost saving 6,000, loss of contribution 8,000. So still you have a 2,000 loss. You should not drop the product. Then that is financial perspective. So financial perspective, when you are taking the decision whether a product is dropped or not, it should be decided by considering contribution of that particular product and avoidable fixed cost. You know, take it percentage. Avoidable fixed cost. If the avoidable fixed cost exceeds the contribution, positive contribution, you have dropped. If a product generates negative contribution, then basically you can say drop the product. Right? Abhi to make it contribution ekak denne minus kiya. That is the case. Is no point of producing the product. Even ignoring the fixed cost, negative contribution. But again, there are some non-financial factors they should consider. Other factors, but it's a main factor that you should focus when you decide dropping a product. Non-financial factors. Assume that this entire 12,000 cost is avoidable cost. So if you can, if you drop the product, you can save 4,000. Take this is rupees 1,000, so this is 4 million. Like per month, you can save 4 million. So your profit will increase up to 23 million instead of 19 million if you drop this product. Still, company may not drop the product by considering other non-financial factors. What are those? In non-financial factors. The non-financial factor you shall consider. When you drop the product X, that may have a negative impact of the other two products. Now, especially if you are selling all three products in the same sales outlet, the customer who come to buy the product X may also buy product Y and Z. When you drop the product X because of its loss making, right? So the customer sometimes come to your business to buy product X, but they buy Z, Y and Z as well. Right? So if you drop this, the existing sales of Y and Z can also be reduced. So if that loss of contribution exceeds sometimes this 4,000, it may be ended up with financial loss, direct financial, right? Direct decrease of the sale from Y and Z, that is possible. Now that is why sometimes some businesses maintain some of the loss-making products. Right? In some portfolios, they are having loss-making product, but they continue the product. Right? Even it's loss-making. The other thing is sometimes it may be affect to their brand image. You are well-established brand, you had the product and now you discontinue. That might give a wrong message to the customers. Okay, this business, they are dropping their product, they are going to close down the business. So that the customer may shift from other brands, other products. That can happen. Business continue with the loss-making product. Right? Because you don't like to damage your brand. Or sometimes they may continue certain sections that will give them some benefit. I can remember a number of years back now, they stopped it after restructuring. Sri Lanka insurance, right? Sri Lanka insurance as one of the leading insurance company, they introduced workshop where they look after the vehicle repairs. When a vehicle met with an accident, again, for the Formula Plus or something, they said at the time they introduced the insurance scheme, right? If the vehicle met with an accident, you can submit the vehicle to their own workshop. The insurance company take the vehicle, because it's a big damage, right? They take the vehicle and they will do it free repair, right? Financially, cost-wise, it was more costly to them. Rather than ask customers to do it somewhere else, because the people used to, because they did it a very quality service, right? They do all the spare parts and everything, right? Because that is, it's like that you go for a company, right? When a vehicle met with an accident, you can do it in a local garage, some other place, or you can go for the company. People reluctant to normally go for the main company, right? Say, for example, if your vehicle is Toyota, if it met with an accident, you go for Toyota Lanka. If you're Hyundai, right, you go for the Hyundai Lanka, right? Honda Stepper. But when you go for that, normally claim is, the bill is very high. Then insurance companies can reduce some of the percentage, like considering age and all. But when Sri Lanka Insurance introduced this workshop, right? So that every vehicle owner, they like to go for that because they will do it. They have to fix it, and they normally replace with the original spare parts and all. It was costly, but it creates huge positive demand. Right? That Sri Lanka insurance, Selico එකෙන් ආපු Selico VIP එකෙන් ආපු threat එක control කරේ okay. ඒගොල්ලෝ ආපු market leader, right? Of the motor vehicle insurance industry. ඒක loss, right? Comparatively, by giving claim was much profitable. But that create more insurance policies for them. More vehicle owners start to take their Lanka insurance policies. That generate the profit. Very profit right? Later, අනිත් cost එක වැඩි වීමත් එක්ක ඒගොල්ලන්ට ඒක maintain කරන්න බැරි වුණා. අනිත් එක ගාක් vehicle ලා ප්‍රශ්නේ වුණේ ඒගොල්ලන්ට අර කෙටි කාලෙකදී දෙන්න බෑ. right? ඒක workshop වල ලංකාවේ වෙදෙන් සියම් delay වෙනවා. ඒතරම් ඒකේ negative impact එකක් එන්න පටන් ගත්තා. vehicle එක එළිය දාලා ප්‍රතිදීන් හදනවා නම් මේක company එකට දාපුවාම සමහරට ප්‍රතිතුනක් යනවා. right? they later they stop it. But those type of factors you have to consider. You should not drop the product, right? So ඒ වගේ වෙන්න පුළුවන්. right? මේ product එකට එන මේ product එක තියාගෙන ඉඳීම නිසා අනිත් products වල sales prepare. right? So සමහර supermarkets කරනවා සමහර divisions ඒගොල්ලෝ තියාගෙන ඉන්න. right? ඒ division එකේ සමහර profit නැහැ, ලොකු profit එකක් නැති වෙන්න පුළුවන්. So සමහර supermarkets වල තියෙනවා bank counter එකක් තියෙනවා. right? ඒක පොඩි rent එකක් දීලා පොඩි income එකක් ඒගොල්ලන්ට එන්නේ ඒකේ. right? ඒකේ ලොකු profit එකක් නැහැ ඒගොල්ලන්ට. ඒකට ඒ space එකේ වෙන මොනවා හරි product එකක් දාලා තිබුණා නම් directly එතන ඒක විකුණන්න පුළුවන්. හැබැයි bank එකට එන customer අර supermarket එකට යනවා. right? ඒකෙන් ඒගොල්ලන්ගේ sales වෙනවා. ඒ සමහර වෙලාවට ඒකේගොල්ලෝ ඉන්ඩියන් රේට් එකකට දුන්නා නම් ඊට වඩා දෙන්න පුළුවන්. හැබැයි ඒගොල්ලෝ ඊට වඩා අඩු ගානක් දෙනවා. මොකද ඒක that will increase the total sales. සමහර වෙලාවට pharmacy එකේ ලොකු sale එකක් එන්නේ නැති වෙනවා. But when the supermarket having the pharmacy, right, the customers when they want to buy some medicines also, right, they go to the supermarket. ඒ නිසා sales. Even the bakery items, right? සමහර වෙලාවට කීල්ස් එකේම කාලයක් කරා ඒගොල්ලන්ගේ අර බ්‍රෙඩ් එකක් තිබුණා මොකද ඒකයි රුපියල් 50 ගාන. right? 2020 එකේ විතර වගේ වෙද්දී සාමාන්‍ය normal බ්‍රෙඩ් එක රුපියල් 50 ගාන. right? ඒ කීල්ස් එකට කියන කවුරුත් ඒක විතරක් අරන් එන්නේ නැහැ. if you go to supermarket, right, you buy so many other products. right? ඒක ඇත්තටම මේගොල්ලෝ දුන්නේ cost එකට වගේ කාලේ. right? එළියේ සාමාන්‍ය පොඩි කඩේකවත් ඒ ගාන නැහැ. right? ඒගොල්ලෝ ඒක දෙනවා. සාමාන්‍ය රුපියල් 60යි නම් ඒගොල්ලෝ 53යි. right? ඒකට ඇත්තටම ගත්තොත් අර බ්‍රෙඩ් වල cost එකට වගේ තමයි දුන්නේ. So they don't have any profit from it. But they earn profit from other products. right? ඒක loss කියලා ඒක වහනකොට that might create some impact to the other sales. So drop making product, you have to consider the impact of other sales, the brand image. Right? That is very, very important. Right? සමහර businesses තියෙනවා ඒගොල්ලන්ගේ ඒ වගේ loss making products තියාගෙන ඉන්නවා. right? They maintain the quality. දැන් උදාහරණයක් හරිස්චන්ද්‍රලාගේ තියෙනවා soap section එක. soap section එක loss. right? හරිස්චන්ද්‍ර soap brand කීපයක් තියෙනවා. ඔතන ඒගොල්ලෝ මේ අතරම quality material ගෙනනවා කියනවනේ. ඒගොල්ලන්ගේ තියෙනවා THC fact එක 78.5 කර. ඒ fact එක තමයි standard එක. right? ලංකාවේ soap වල කීපයයි තියෙන්නේ. ඔය standard එකේ තියෙනවා මේ product එකක් ඒවා THC එක අඩුයි ඊට. right? ඒගොල්ලෝ අර එතනම හොත් මේ ගාන සපන්නන් එන්න ඕන. ඒක යන්නේ toilet soap කියන. තමයි ඒක standard එක. අපි අය එකක් හදාගත්තා bathing bar කියලා. right? ඊට වඩා අඩු level එකකට දාලා ඒකට දාලා තමයි ඔය තුගා brand විකුණන්නේ. right? ඔයගොල්ලෝ සපන් වල බලන්න 78.5 THC කියලා තියෙනවා නම් ඒක තමයි ඇඟේ ගන්නට හොඳ level එක. එතනින් එහාට ලකවගක් තියෙන 70 65 එහෙමත් තියෙනවා. ඒකට ඇඩ්වර්ටයිස් කරනවා ඉතින් මිනිස්සු ඒක අර ගන්නත් නැහැ ගන්නවා. ඒක හොඳ නැහැ. right? artificial මේකක් තියෙනවා. හරිචන්ද අරක මේන්ටේන් කරන එක brand එකක්. හැබැයි ඒගොල්ලෝ loss. මොකද ඒක price එක ඒගොල්ලන්ගේ ස්ටෝක් එකක් පොඩි. අර cost එකත් එක්ක යාලට බෑ. ගොඩාක් price කරොත් ඉකිනෙන්නෙම නේ. right? ඒත් ඒගොල්ලෝ මොකද මිනිස් ප්‍රමාණය බලනවා. ප්‍රමාණයේ price එකයි එක ඒගොල්ලෝ price එක competitive තියා ගන්නවා. ඒ section එක loss. by initial දැන් ඒගොල්ලෝ ගොඩාක් established and soft market එක. ඒගොල්ලන්ගේ brand එකක් තියෙනවා ඒකට හරිචන්ද. ඒගොල්ලන්ගේ product range එකක් තියෙනවා that is enough profit. So they don't like to damage that brand. ඒගොල්ලෝ දැන් හරිචන්ද කියලා මෙහෙම එකක් පටන් කරා close කරා. ඒගොල්ලෝ අර continue කරනවා. ඒක යම් customer base එකක් හදාගෙන I don't know the reason here. 2021 ඔය කාලෙත් ඒගොල්ලෝ loss. right? business එක profit. their section එක loss. Even the section is loss they can එහෙම තියෙනවා. මේ කාගිස්සගේ සමහර තියෙනවා section loss. right? ඒගොල්ලෝ ඒක continue කරනවා. right? because that will affect to the total demand. right? Then make or buy decision. Another decision business should make or buy. That means whether you purchase it from outside or you make it by your own. right? Transfer pricing වලත් අපි කතා කරේ. right? ආයතනයේ පැත්තේ බලපුවාම එළියෙන් ගන්න එකද වාසි? ඉතින් හදන එකද වාසි? එතනදී normally you have to consider the variable cost of making and external purchase price. But in addition to that, when you are making, there may be opportunity cost. If you are utilizing the full capacity or if you are utilizing some of the restricted resources like labor hour, machine hour, there may be loss of contribution because you have to reduce the other product. That you have to take into consideration. මෙතන relevant cost එක ගන්නකොට decision එක ගන්නකොට make or buy එළිය ගන්න purchase price එක අපිට 50යි. හදන්න යන්නේ අපිට 40 now. Directly variable cost 40 you can say okay 40 is profitable. But you have to consider when you are using this product, when you are producing it within the business, some of the other product that you can use using the same machines or labor can be reduced. That might have opportunity because that should take into consideration. And sometimes when you decide to make, there may be additional fixed. Or if you decide to, without making, go for the purchase, existing cost that you are incurring for the production, some of the fixed cost may be avoidable. The avoidable fixed cost එකක් consider කරන්න. The variable cost, opportunity cost, avoidable fixed cost become relevant. Right? කලින් අවස්ථාව වගේ එකක්. Okay, here we have an activity. A firm manufacturer XL 200 component. The cost of the production at the current level 50,000 units. Raw material 2.5, labor 1.25, variable overhead 1.75, fixed overhead 3.75. The component put brought for 7.75. If so, the production capacity utilized at present would be unused. Whether a company should manufacture or purchase. So the effect based on your calculation, right? So basically, here the relevant cost is the variable cost, right? So product L200 selling price per unit අපිට දීලා තියෙන්නේ. Selling price per unit selling price එක අපිට දීලා නැහැ. අපිට දීලා තියෙනවා right. අපි variable cost එක බලමු. Raw material, labor, variable overhead. Per unit. Labor per unit. Variable overhead per unit. Variable cost per unit. 0.5, 1.25, 1.7. So the variable cost is $5.5 extra purchase price can buy it from the outside 7.75. So comparatively, manufacturing internally is more profitable, right? So increasing profit by manufacturing financial calculate කරන්න තියෙනවා, right? බලන්න අපිට 50,000 units හදනවා. එක unit එක saving එක තියෙනවානේ ₹2.25. So we can save $12,500 saving. Profit එක වැඩි කරන්න පුළුවන්. Purchase කරනවට වෙනුවට purchase කරපුවාම variable cost එක විතරයි යන්නේ. And it's clearly mentioned if you don't purchase the capacity space, ඒ කියන්නේ අපි දැනට extra capacity තියෙනවා. Right? මේක opportunity cost එකක් දීලා නැහැ. And it's clearly mentioned if you are not producing. If so, the production capacity utilized at present would be unused. You can spare capacity තියෙනවා කියන්නේ. At the moment we are using the full capacity and we have alternative product which we can use out of this, then you have to consider that also, right? So make a relevant cost එක උනේ variable cost එක විතරයි. In this activity we take variable cost, only relevant cost. And there is a fixed overhead. The question silence about it. So here I assume all fixed overhead cost is unavoidable, right? Commonly incurred. Whether we produce or whether we buy externally, that fixed cost should have been incurred. Under that assumption, we take this profit increase by 112,000, right? Allocated fixed cost එක තියෙනවනේ. Allocated fixed cost එකක් තියෙනවා මේ unit එකට. Per unit 3.5 into 50,000 units we are producing. And මේ decision එකට එන්නේ මෙන්න මේ entire fixed cost is this is assumed as unavoidable. මේක අපි unavoidable කියලා assume කරා. Under that condition, can make it but in the examination question එක අපිට මේක තව තොරතුරු දෙන්න පුළුවන්, right? මේ fixed overhead cost එකේ you were given some cost could have been avoided if you purchase from the outside. Then make 112,500 increment එක අපිට දෙනවා, right? මේ allocated fixed cost එකේ 50% save කරගන්න පුළුවන් if you purchase outside. That means 50% of this fixed cost is specific, avoidable if you go for the purchase rather than produce. එහෙනම් profit එක බලනකොට මේ 112,000 වලින් මේකේ 50% අඩු කරා. right? 87,500 still it may be profitable by purchase. Right? And if you are given, if you if you are manufacturing this product, there are some other existing product demand should have production should have been reduced. So there will be the contribution that you could have obtained. Right? අපි તો මේ unit 50,000 හදාට පාවිච්චි කරන resources වලින් තව වෙනත් product එක unit 25,000ක් හදන්න. ඒ 25,000 එකකින් රුපියල් 2ක් හම්බ වෙනවා නම් රුපියල් 50,000ක contribution loss එකක්. That also take into consideration. Right? ඒ තොරතුරුත් එක්ක තමයි අපි final decision එකට යන්නේ. Right. So basically this is what sell or further process decision. එතකොට මේකත් අපි කතා කරා. අර මම මුලින් example එක දෙගත්තේ මේ අපි රුපියල් 200ට ගත්ත products තියෙනවා, right? We purchase for 200. Market price is 150. We are making offer for 160. Or we can further process it and sell it for 180. right? එතකොට existing විදියට විකුණනවාද further process කරනවාද කියන එකේදී බලන්න ඕනේ, right? Further processing cost එක 10 rupee නම් increasing the selling price 20 නම්, so incremental benefit of further processing. You have to consider the incremental cost and incremental revenue of further processing. Product as it is, material as it is, you can sell for 160. Further process by incurring 10 rupee, you can sell it for 180. So there is an incremental profit of 10 rupee by further processing because additional revenue 20, additional cost is 10. So in that case, go ahead for the further processing. එතනදී තර ගන්න පුළුවන් further processing වලදී further process කරනකොට there may be loss of contribution of existing product and there may be additional fixed cost we have to be. Right? So the short term decision making වලදී basically consider කරන්නේ variable cost එක. Relevant cost is the variable cost. Opportunity cost should be taken into consideration. Opportunity cost become relevant cost. Avoidable fixed cost by a decision become relevant cost. sunk cost, which is already incurred, cannot be reversed. Committed cost, not being incurred but committed. Those are irrelevant in decision. Okay. So we have taken this one also. Right. I mean, 10% DNA vertical. Right. 1, 2, 3, 4. 40% of the tank cover right. In content technique. සමහර ඒවා ඔයගොල්ලෝ assignment එකට මම link කරලා තියෙනවා. Like environmental aspect of cost management, pricing decision, right? අපි උගලන් ඊළඟ සතියේ මෙන්න මේකට යන්න. Long term decision making, investment appraisal, හැබැයි ඒකේ අපි advanced aspect කතා කරන්නේ. ඒ කියන්නේ අපි ඔයගොල්ලෝ basic, I hope that you know the basic project appraisal techniques like ARR, payback, NPV calculation, right? Hope that you all basically aware of that. Right? So make it ඊට වඩා advanced aspect එකක් තමයි cover වෙන්නේ. Get here. Long-term decision making, advanced investment appraisal, tax, incorporating tax into discounting rates and the cash flows. Inflation adjusted cash flows, right? අපි තමයි nominal value එකනේ. අපිට පුළුවන් inflation adjusted කරන real ඒක discount rate එකක් real discount rate ගන්න පුළුවන් නැත්නම් cash flow එක real cash flow ගන්න. ඊළඟට unequal life තියෙන වෙලාවට projects වල. එක machine එකක් අවුරුදු 7ක් පාවිච්චි කරන්න පුළුවන් අනිත් machine එක අවුරුදු 5යි පාවිච්චි කරන්න. ඒක කොහොමද? basic NPV සාමාන්‍ය NPV එකෙන් decision එක ගන්න බෑ. right? ඒක පාවිච්චි කරනවා මේ equivalent method කියන. Yeah, capital rationing, that is that some of the positive NPV project we may not be accepted because of some other constraint, right? Then environmental political aspect of the economic saman investment, right? We should not take the decision purely based on NPV positive, rather than that. Right? So those part we are going to discuss next week, right? So project appraisal right? Basically NPV, right? More advanced version. මම ඉස්සර වෙලා basic NPV ගානක් හදලා right? ඒක මතක් කරගෙන අපි මේ advanced steps වලට යමු. Right? Okay. With that, I'll wind up today's session. So we can have the last one.